Have you ever dreamt of becoming a millionaire? It's a common aspiration, but many people believe it requires risky bets or secret formulas. The truth is far simpler and more achievable than you might think. Building wealth doesn't require winning the lottery or mastering complex trading strategies. It's about making smart, consistent investments over time, and that's where index funds come in. We'll debunk common myths, expose potential pitfalls, and equip you with the knowledge to make informed investment decisions. One of the biggest misconceptions about index fund investing is that it's boring. People often associate wealth building with thrilling market swings and trying to time the perfect buy or sell. But the truth is, slow, steady growth through index funds can be incredibly effective, outperforming even the most sophisticated actively managed funds in the long run. This approach is about building wealth gradually and securely, not overnight riches. Think of it like building a house. You wouldn't try to erect the entire structure in a day. Instead, you lay a solid foundation and add bricks one by one, gradually working towards completion. Start your journey to financial freedom today. Take the first step towards a secure and prosperous future with index fund investing. Imagine trying to pick the fastest horse in a race. You could spend hours studying their forms, analyzing their past performances, and listening to expert opinions. But even then, there's no guarantee your chosen horse will win. Now imagine betting on the entire field of horses instead. That's essentially what index fund investing is all about. An index fund is like a basket of stocks or bonds that mirrors a specific market index, such as the S&P 500. Instead of trying to outsmart the market by picking individual winners, you're investing in the overall performance of the market itself. This approach eliminates the guesswork and emotions often associated with stock picking, providing a more stable and reliable path to long-term growth. One of the key advantages of index funds lies in their simplicity. They offer a diversified portfolio of assets with a single purchase, making them ideal for both novice and experienced investors. Despite their proven track record, index funds are often surrounded by misconceptions that prevent people from realizing their full potential. Let's debunk some of these myths and shed light on the truth about index fund investing. Myth 1. Index funds are only for passive investors. While it's true that index funds follow a passive investment strategy, it doesn't mean you have to be passive about your financial future. You're still in control of your investment decisions, choosing the index funds that align with your financial goals, risk tolerance, and time horizon. Myth 2. Index funds offer average returns. This is a common misconception. Index funds don't aim for average returns. They aim to match the returns of the market they track. Over the long term, the market tends to go up, and by investing in index funds, you're capturing that growth potential. Remember, it's not about beating the market. It's about joining it and riding the wave of its overall upward trajectory. Myth 3. Index funds are boring. Some find the idea of simply tracking the market unexciting compared to the thrill of active trading. However, the true excitement lies in watching your wealth grow steadily over time, knowing you're on a solid path to financial security. Imagine you're a surfer paddling out to catch a wave. You wouldn't jump on your board and expect to ride every ripple and current. Similarly, the stock market has its ups and downs with periods of growth and periods of correction. Trying to time these fluctuations is like trying to predict the ocean's every move, nearly impossible. Index funds take the guesswork out of this equation. By investing in the entire market, you're essentially riding the overall wave, not trying to predict every twist and turn. While there will be dips and surges along the way, history has consistently shown that the market trends upwards over the long term. Just like a surfer patiently waits for the perfect wave, index fund investors benefit from staying the course. By riding out the market's natural fluctuations, you're positioned to capture the cumulative growth potential that comes with time and compounding. Imagine putting all your money into a single stock, even if it's from a seemingly promising company. If that company faces unexpected challenges, your entire investment could be at risk. That's why diversification is crucial for any sound investment strategy. Think of diversification as building a sturdy bridge. You wouldn't want to rely on a single pillar to support the entire structure. Instead, you'd use multiple pillars strategically placed to distribute the weight evenly. Similarly, diversification in investing involves spreading your money across different asset classes, sectors, and geographical regions. Index funds inherently promote diversification by holding a wide array of stocks or bonds within a particular market segment. Imagine going for a run, only to realize you've been carrying a small but noticeable weight on your back the entire time. While it may seem insignificant at first, that extra weight can slow you down and hinder your progress over the long haul. The same principle applies to investment fees. Even seemingly small fees can erode your returns over time, significantly impacting your overall wealth accumulation. This is where index funds truly shine. Due to their passive management style, they typically have significantly lower expense ratios compared to actively managed funds. Actively managed funds charge higher fees to cover the costs of research, analysis, and portfolio management. However, studies have consistently shown that actively managed funds often struggle to outperform their benchmark indexes after accounting for fees. Now that you understand the power and potential of index funds, let's discuss how to choose the right ones for your investment portfolio. Just like a well-coached team needs a winning playbook, you need a strategic approach to index fund selection. First, define your investment goals and risk tolerance. Are you saving for retirement, a down payment on a house, or your child's education? Your financial goals will determine your investment time horizon and the level of risk you're comfortable taking. Next, choose your asset allocation. This refers to how you divide your investments among different asset classes, such as stocks and bonds. Stocks generally offer higher growth potential but come with higher volatility, while bonds provide more stability but with lower potential returns. Then, select your index funds. Once you've determined your asset allocation, you can start choosing specific index funds that align with your strategy. Consider factors like the index tracked, expense ratios, and the fund's historical performance. Don't forget to diversify across market segments. Consider investing in index funds that track different sectors, such as technology and healthcare, and geographical regions like the US, international, and emerging markets, to further mitigate risk. Remember the classic fable of the tortoise and the hare? The hare, confident in its speed, takes a nap during the race, while the tortoise, slow and steady, wins in the end. This timeless story perfectly illustrates the difference between index funds and actively managed funds. Actively managed funds are like the hare. They rely on skilled portfolio managers who try to beat the market by picking stocks they believe will outperform. While this approach may seem enticing, it often comes with higher fees, increased risk, and no guarantee of success. In fact, studies have consistently shown that most actively managed funds fail to outperform their benchmark indexes over the long term. Index funds, on the other hand, are like the tortoise. They don't try to outsmart the market, they aim to match it. They steadily track their designated indexes, providing broad market exposure at a fraction of the cost of actively managed funds. In the realm of investing, patience is not just a virtue, it's a superpower. Building wealth through index funds is a marathon, not a sprint. It requires a long-term perspective and the discipline to stay the course, even when the market throws its inevitable curveballs. Imagine planting a seed and expecting it to blossom into a magnificent tree overnight. It takes time, nourishment, and consistent care for the seed to sprout, develop roots, and eventually reach its full potential. Similarly, building wealth through index fund investing requires time for your investments to grow, compound, and generate significant returns. The magic of compounding is like a snowball effect. As you invest consistently over time, your earnings generate even more earnings, creating a virtuous cycle of growth. The path to becoming a millionaire through index fund investing is not a pipe dream. It's a tangible reality within reach for anyone willing to embrace the principles of patience, discipline, and long-term thinking. You don't need to be a financial expert or have a large sum of money to get started. The key is to take that first step today and begin your journey towards financial freedom. Start by educating yourself about index funds and developing a solid understanding of the concepts we've discussed in this essay. There are countless resources available online at your local library and through reputable financial institutions. The more knowledge you acquire, the more confident you'll feel in making informed investment decisions. Next, create a budget. Identify areas where you can reduce expenses, and start setting aside a specific amount of money each month for investing. Remember, even small contributions, made consistently over time, can grow exponentially thanks to the power of compounding. Finally, choose a reputable brokerage account, select your index funds based on your investment goals and risk tolerance, and automate your investments. Automation ensures that you're investing consistently, regardless of market fluctuations or your emotions. So, what are you waiting for? Take action now and start your journey to financial freedom today.